All right, let's just dive right into this explainer. I mean, we see the flashy AI headlines literally every single day, right? Another $100 billion here, another mega campus there. Honestly, the numbers have gotten so massive they kind of just stop registering. But wait, we shouldn't be moving on so fast. Today, we're going to investigate how the biggest tech companies in the world are secretly funding the largest infrastructure build-out in human history.
So the answer to how they're paying for all of this, well, it starts with this staggering figure, $1.65 trillion. Yeah, trillion with a T. That is the hidden debt quietly financing the AI revolution. And what's truly mind-blowing here is that this massive financial burden is sitting completely off the books of just 5 major tech companies. It's, basically invisible to the average investor.
And this brilliantly illustrates the illusion. On one side, you have the debt these top 5 tech giants actually report to the public, which is about $1.35 trillion. Okay, huge number. But on the other side, the mountain of hidden, off-balance sheet debt they've accumulated is actually much larger, $1.65 trillion. The hidden pile has completely eclipsed the visible one. Take Meta, for example. Their off-balance sheet debt is almost triple what they actually report.
Now, to understand why they feel the need to hide this debt, you really have to grasp the sheer scale of what's happening. Jensen Huang, the CEO of NVIDIA, hit the nail on the head when he called this the largest infrastructure build-out in human history. I mean, with roughly $700 billion being spent this year alone, which, to put that in perspective, is about 2.5 cents of every single dollar the entire U.S. economy produces, these companies need unprecedented amounts of cash to fuel this massive expansion. Section 1. Return of Shadow Banking. Okay, so to understand how they actually hide this borrowing, we've got to revisit a financial ghost from the 2008 crisis, the shadow banking system. Wall Street has spent the last 2 decades trying very, very hard to forget the system. But here we are. These non-bank entities act as the perfect legal shield for moving massive liabilities totally out of sight. It's called a special purpose vehicle, or SPV. It's basically a company created purely on paper. It has its own name, its own bank account, and crucially, its own debts. Let's look at how this works in practice. We'll use a fictional Acme corporation. Say Acme needs a mountain of cash, but they absolutely don't want the debt on their books. Step 1, they create an SPV. Step 2, the SPV takes on all the debt to build a massive data center. And finally, step 3, Acme just simply rents that data center back from the SPV. Acme gets everything they want, and the SPV is left holding the bag. It is essentially like opening a credit card in your cousin's name. Seriously, you get to swipe the card, you get to keep all the goods, but when the bank knocks on your door asking about your liabilities, your answer is technically zero. Back in 2007, this shadow machinery was built on mortgages. Today, it's being built on data centers. Section 2. Running out of cash. Now, you might be wondering, why did the most cash-rich entities on Earth need to borrow from the shadows in the first place? Well, historically, these giants were practically printing money, using about 45% of their cash flow to reinvest in their business, a very comfortable margin. But this year, that number has rocketed to an estimated 94%. That means the AI build-out is literally draining their vaults. The cash machine is just being eaten alive by the sheer cost of these facilities. So when the cash ran dry, they did what any company would do. They hit the traditional bond markets. But they did it so aggressively that the numbers are just staggering. Look at this. From 2020 to 2024, they averaged about $28 billion a year. But in just the first 5 months of 2026, they borrowed $115 billion. That is more in 5 months than the previous 5 years combined. And get this, the US dollar market, the deepest capital market on Earth, literally could not absorb this level of borrowing. We even have senior officials at the IMF raising red flags about financial stability. Because the US market was totally tapped out, companies like Alphabet were actually forced to issue 100-year bonds across foreign currencies literally overnight, just to keep the money flowing. But somehow, even that wasn't enough. Section 3. The Project Beignet Loophole. Once traditional borrowing limits were maxed out, big tech had no choice but to turn to the shadows. And we can see exactly how it works by looking at the largest project financing ever completed, Project Beignet. Yes, whimsically named after a New Orleans fried pastry. This is a $27 billion investment-grade bond funding a multi-gigawatt Meta data center in rural Louisiana called Hyperion. Meta designed it, Meta is building it, and Meta will be its only tenant. But on paper, All $27 billion of that debt technically belongs to an SPV named Beignet Investor. And this brilliantly illustrates the accounting magic at play here. A private investment firm called Blue Owl Capital puts up 80% of the equity, while Meta takes the other 20%. Now, because of a single freeze in accounting rules, Meta legally owning just 20% means they are not considered the primary beneficiary. Poof! Just like that, a $27 billion liability vanishes into thin air from Meta's balance sheet.
But if you dig deep into the footnotes, the stuff only finance geeks usually read, you'll find the safety net. Meta actually promises bondholders that if they walk away and the building loses value, they will cover losses up to $28 billion. However, the bonds run out to 2049, while Meta's lease is structured in short 4-year chunks. This clever little mismatch allows them to successfully tell Wall Street it isn't their debt while quietly guaranteeing the bondholders they're fully covered. It's an absolute masterclass in having your cake or your beignet and eating it too. Section 4, a systemic industry pattern.
Now, if this was just one highly creative accounting trick by a single company, it wouldn't really be a systemic crisis. But BigNet has become the exact template for the rest of the industry. BlackRock recently started marketing Project Sophia, which is a $12 billion sequel for another Meta data center in Texas using the exact same 80/20 SPV structure. And it's definitely not just Meta. Law firms are reporting that more than $120 billion has been moved off balance sheets across the sector in under 2 years. The trend is accelerating like wildfire.
Which brings us to the truly alarming scope of the issue. Morgan Stanley estimates that the total off-balance sheet exposure across the entire tech industry has reached a staggering $1.8 trillion. $1.8 trillion. And what makes this incredibly fragile is that it's backed by the exact same small club of lenders on almost every single deal. I mean, if 5 massive borrowers use one structure funded by a handful of lenders, the risk stops being diversifiable. It's essentially the same exact bet written 5 times over.
Section 5, the four-legged parlay.
So the crucial point here is that this is no longer just an investment in some exciting emerging technology. When you step back and look at the financing, it is the most massive, highly leveraged financial bet in modern history. For this massive shadow debt to actually pay off, it acts like a four-legged parlay where every single leg has to hit perfectly without fail. First, AI revenue has to multiply, not just grow, to cover that $700 billion annual spend. Second, returns on cloud investments, which have already slid from 40% down to 20%, have to stop shrinking. Third, facing a projected $1.5 trillion shortfall by 2028, that shadow borrowing window has to stay wide open. And fourth, the physical power grid must somehow absorb all this crazy new energy demand.
Every single one of those 4 structural legs absolutely has to hold up under the weight of the largest infrastructure build-out ever. So, as we leave you with this final thought in today's explainer, consider the extreme fragility hidden deep in these public filings and footnotes. We really have to ask ourselves, what happens to the broader economy if just one leg of this massive $1.8 trillion shadow bet breaks? Are we truly prepared for the fallout if the AI bubble pops?